Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Russell Rhoads, Director of Derivatives Research at EQDerivatives, to discuss Nasdaq Volatility Index, or what we call VOLQ. Russell, it's great to have you as always. Welcome back to Trade Talks.
It's great to see you. Happy September. That's always a fun month for the markets.
It went by incredibly fast. We are going to start into Q4 in less than 30 days at this point. And to your point, Russell, September is always interesting. It has the reputation for being a volatile month. And you and I always like to take a look at what that means in terms of the Nasdaq Volatility Index, how that compares to VIX, and what we can discern in terms of Nasdaq 100 and S&P 500 performance. So let's get into it.
Absolutely. So one of the great things about volatility indices is they are forward-looking, and they do give us a true mind of the market. So you can compare VOLQ to VIX, and that's what I've done here. And I took a look at where's VOLQ, where's Nasdaq anticipated volatility been relative to S&P 500 anticipated volatility at the end of August every year. And I found we've got 7 years of data for VOLQ, and I actually found that when VOLQ is lower than VIX on the last day of August, the S&P 500 will actually underperform the Nasdaq. Nasdaq outperforms when VOLQ is at a discount. When VOLQ is at a premium, which means there's more risk being priced into the Nasdaq than the S&P 500, the S&P 500 actually outperforms. And this has been 7 for 7 on all 7 years going back in history that we have.
Is there any reason to that because of the way that VOLQ is constructed versus VIX?
Not necessarily, because VOLQ, even though you're referring to VOLQ being calculated using at-the-money options versus VIX, which uses a whole strip of options, so you get that influence of out-of-the-money puts, which typically have higher implied volatility than at-the-money option contracts, which does push VIX to generally higher levels than it would if that methodology was applied to the Nasdaq 100. But even though VOLQ is at-the-money implied volatility, it typically is about 60+% of the time at a premium relative to VIX, which indicates that some of these new technology stocks are a little bit riskier than some of the stodgy old blue chips that are in the S&P 500. But having the thing that really stood out to me is in 2014, 15, and 16, each of those years, VOLQ was at a discount coming out of the summer, and what you ended up with was the Nasdaq outperforming the S&P 500.
Right. Well, and it kind of makes sense, because when we think about what we saw in August, despite all of the headlines, whether it's inflation, whether it's geopolitics, whether it's COVID variants emerging, it was surprising, not just for Nasdaq 100, but for S&P 500 to perform as well as it did. It was that basket of those large heavyweight tech stocks. And, the risk to that is because of their waiting for how they move is really going to impact index performance. So it does make sense when you think about it in that way, as it matches up to the fundamentals that we're watching.
Oh, absolutely. And when I speak to you next month, we're going to talk about earnings, because next month is an earnings month and what VOLQ can tell you around that. But for this year, we talked about the history. On the last day of August this year, we had VOLQ at an 11.5% discount to VIX, which means if we go 8 for 8, the NDX will outperform the S&P 500. And as I sit here right now, NDX is up about 0.7% for September, and the S&P 500 is flat. So we've still got plenty of trading to go in September. But as of right now, that signal's looking 8 for 8.
So there is some rhyme and reason to all that derivatives research and math that goes behind all this. Russell, great to see you as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.